All right, everybody, we're going to jump right to Powell here because he is in the middle of his address. So let's just get to it.
Meeting, the committee judged that the economy has met this test and decided to begin reducing the pace of its asset purchases. Beginning later this month, we will reduce the monthly pace of our net asset purchases by $10 billion for Treasury securities and $5 billion for agency mortgage-backed securities. We also announced another reduction of this size in the monthly purchase pace starting in mid-December, since that month's purchase schedule will be released by the Federal Reserve Bank of New York prior to our December FOMC meeting. If the economy evolves broadly as expected, we judge that similar reductions in the pace of net asset purchases will likely be appropriate each month, implying that increases in our securities holdings would cease by the middle of next year. That said, we are prepared to adjust the pace of purchases if warranted by changes in the economic outlook. And even after our balance sheet stops expanding, our holdings of securities will continue to support accommodative financial conditions. Our decision today to begin tapering our asset purchases does not imply any direct signal regarding our interest rate policy. We continue to articulate a different and more stringent test for the economic conditions that would need to be met before raising the federal funds rate. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to complete the recovery in employment and achieve our price stability goal. Thank you. I look forward to your questions.
Thank you. We'll go to Nick at the Wall Street Journal.
Stay tuned here.
Hi,
guys,
Nick Timberos of the Wall Street Journal. Chair Powell, the markets anticipate you will raise rates once or twice next year. Are they wrong?
So, I would say it this way. We try to focus on what we can control, and that is how to communicate as clearly as possible in this highly uncertain world how we're thinking about the economic outlook and the balance of risks, and how policy will evolve in that case, and also in the cases which are frequent where the economy evolves in unexpected ways. So the focus at this meeting is on tapering asset purchases, not on raising rates. It is time to taper, we think, because the economy has achieved substantial further progress toward our goals, measured from last December. We don't think it's time yet to raise interest rates. There is still ground to cover to reach maximum employment, both in terms of employment and in terms of participation. Getting to your question, our baseline expectation is that supply bottlenecks and shortages will persist well into next year, and elevated inflation as well, and that as the pandemic subsides, supply chain bottlenecks will abate and job growth will move back up. And as that happens, inflation will decline from today's elevated levels. Of course, the timing of that is highly uncertain, but certainly we should see inflation moving down by the second or third quarter. The time for lifting rates and beginning to remove accommodation will depend on the path of the economy. We think we can be patient. If a response is called for, we will not hesitate. So what I will tell you is we're watching carefully to see whether the economy evolves in line with our expectations, and policy will adapt appropriately. And that's what I would say.
Just in short, we did get the 75 basis points in. We'll talk a little bit about the impact of this as well.
Do you think it's possible or likely even that maximum employment could be achieved by the second half of next year?
So if you look at the progress that we've made over the course of the last year, if that pace were to continue, then the answer would be yes. I do think that is possible. Of course, we measure maximum employment based on a wide range of figures, but it's certainly within the realm of possibility.
Thank you.
Thank you. Next, we'll go to Gina at the New York Times.
Hi, Chair Powell. I was wondering if you could detail a little bit how you're thinking about wages at this moment. Obviously, we're seeing strong wage growth, particularly for people in sort of lower income fields. I wonder if you see that as a positive thing or as a potential start to a wage price spiral, and sort of how you sort of delineate those two things.
So wages have been moving up strongly, very strongly. And in particular, I would point to the Employment Compensation Index reading that we got last Friday. Now, in real terms, they had been running a little bit below inflation, so real wages were not really increasing. I think with the ECI reading, it becomes close to
is a past 75, so kind of prepping you guys before what we're going to hear, even though the 75 basis points has been announced for this particular meeting, just to give you a heads up of the number of 75 basis points that have been hitting. So this, of course, is one of the past videos that the Fed put out. So we will get into all of that. I want to cover a couple of things, because the first article that really kind of broke loose was this one right here. Okay, now I'm getting some feedback. I'm on the delay. Yep, there it is. All right, so this article right here, CNBC, we kind of broke into this. Fed announced their fourth consecutive jumbo interest rate hike. This was the 75 basis points. We're getting ready to see the conversation from Powell, but I wanted to kind of compare the previous meetings, because this is now the fourth consecutive number in terms of 75 basis points that we've seen. And the reason for that, I think, is to really take a look at whether or not the same kind of markers are in place going forward. And I think that is probably going to be the biggest key. Obviously, job numbers will be a continued concern. We'll be dealing with a lot more in the aspect of what could be happening on the supply chain side of things, especially on the demand side, because this is one of the things that I think a lot of people are overlooking. And we've talked about this before on the aspect of just the scenario where the macro analysts that we've had many times that have kind of come on. And some of the things that were in this article that I thought were interesting. So this is the year-over-year inflation rate hike remaining stubbornly high. This is kind of the scenario that they've played into. The June peak of 9.1% to 8.2% as of September. This is obviously coming from the CPI. And then Powell basically reaffirmed his commitment to lowering inflation with the continued rate hikes in recent months. So this is another thing. However, in August, he acknowledged that increasing the cost of borrowing will bring some pain to households and businesses. Now, this is something that we've talked about many times, and that is just the aspect of how this is going to affect the banking industry, how this is going to affect just traditional consumer credit. Who were we on with just the other day that really kind of got into consumer credit? But the point was, I think it was Darius and Dr. Jeff, where we were talking about where consumer credit was going to be going and when we start to see the potential fall off of the household savings start to crack into this. So these are the kind of things that really will cause a little bit more of a trailing effect that essentially right now, if you just jump back to this is the fourth hike. So with a trailing effect and the fact that we're going into maybe a continued fourth quarter issue, because I still think we have an earnings problem that we're going to see just in the regular traditional securities. And I think more and more of this is going to play into a much harder 2023. Now, the question is whether the Fed sees it that way. Does Powell see it that way in terms of Q1 or Q2? As you saw in the earlier piece, is he was already anticipating that we might have to adjust based on economic growth, which we have actually seen. Obviously, the real estate market, all those kind of things kind of play into it. So it's just something that that you need to be aware of as we get into that, because it's a factor that I think a lot of people have not necessarily considered in terms of that lagging scenario, especially around just all of those areas, whether it's real estate, the jobs problem, which I think still is going to be a Q1 issue, more so than happening even in Q4, which we're in the middle of right now. I want to jump to a couple of tweets here. I thought that just to kind of frame it, because we're getting ready to go into the live. But yeah, this one right here, if Fed does a 50, which we know now, it's going to lose credibility. Yes, that's true. Fed does 75, Powell will lose credibility. Yeah, I don't know. Remember, this is what he said right there. This is exactly the point of what that video showcases. I don't expect the 75 to kind of be a common thing, even though this now we're on the fourth. So a big one there. Here was another tweet right here, early 2001. This came from Macro Alf. Fed pivoted as earnings and the labor. Looks like they're getting ready to go live, but he's not on stage just yet. Earnings and the labor market were weakening after Animal spirits ran hot in 2000. So the Fed cut by 150 basis points. A few months later, the USD appreciated, 6%. Equities dropped another 10. So his point is a pivot due to material economic weakness isn't bullish. And that's something that we've talked about here on the show quite a bit. And we've had the macro guys on multiple times, all of which have been kind of pointing to this very issue. So definitely something for sure. I just want to make sure that the guys have the feed coming in. You guys okay on audio coming in over there if you need it? Okay, perfect. All right, looks like they're just now getting ready to prep for Powell coming on to address afterwards. I also wanted to jump over to this tweet right here. You got a lot of other things happening, guys. All right, let's just not forget the macro pressures that really play into this. Looks like Powell's coming on right now, so let's go ahead and cut to that feed.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
We'll definitely do a follow-up here, guys, give you some live sentiment as well.
Thank you.
On
Colby
Bitcoin,
Smith with the
ETH, all
Financial
that good
Times.
stuff.
On the
Let's take a
need
look
to
at what
slow
they're
the
asking.
pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program, if I may, and hit to talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was and has been how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate, and we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time, and we put that into our post-meeting statement because that really does become the important question we think now is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming. And it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restricted, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember though that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick?
Nick Tamarosa, the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high 4s, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher. I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many, many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, many different people who publish an assessment of underlying inflation.
Thank you.
We'll break this down for
Hi,
you
Chair
guys
Powell.
as
Thank you
well.
for taking our questions. Gina Smiley, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter term inflation expectations moved up between the last meeting and this meeting. And we don't think those are as indicative, but they may be important in the wage setting process. There's a school of thought that believes that. So that's very concerning. I guess the other thing I would say is that the longer we're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel. Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to the lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity, and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do. And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment
right
costs
there,
in particular,
huge
will be
statement by
much
him.
higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And
If I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this: it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting a new summary of economic projections which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Yeah, we'll get you guys a wrap up.
Axios.
And
As you look around the
here
economy,
shortly.
the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of labor market, consumer demand. A lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is just very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. So, sorry, was I getting to your question there?
No.
Oh, housing, the housing part of it. Yeah, so, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that's really where a very big effect of our policies is.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers, and I'm just curious
We'll get into some details on this,
to what
guys.
extent you do and don't draw signal from
Make sure
that.
to smash the
So,
like button.
for
We like
example,
these restreams.
if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just another data series. It's been unusually important in this cycle because it's been so out of line, but so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, very small increase this year. which we thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see, so I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside, that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's the picture. Do we
Kathy
see?
Wood, not gonna be happy
we keep
with this
looking
one.
for signs that sort of the beginning of a gradual softening is happening, and maybe that's there, but it's not obvious to me because wages aren't coming down; they're just moving sideways at an elevated level, both ECI and average hourly earnings. We want to see. We would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought because, and that, the data series is volatile. We never take any one reading. We always look at, 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that. That'll be discovered empirically.
There is so much
Thank you so
to
much.
unpack
Kayla
here,
Tausche
guys.
from CNBC.
He's just given us
Earlier
a crystal ball,
last
I
month,
think,
the
for
United
what we'll see.
Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the U.S. that would seem to be bucking those trends.
So, of course, we keep close
We just
tabs
don't
on
have the energy
economic
pressure. It's that
developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine, and we're seeing China's having issues with the zero COVID policy and much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully. Even though it may be difficult to get it back, getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer-term inflation expectations anchored, and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Hi, Chair Powell. Janelle Marte with Bloomberg. So the Fed is facing two more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common?
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of the policymakers violates or falls short of those rules, we do risk undermining that trust, and we take that very seriously. We do.
And ammo.
So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. We've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that the problems with President Bostic's disclosures were discovered when he filed his new disclosures. That's, we now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures, and also all of their trades. Any trade anyone has to make who's covered has to be pre-approved. And there's a lag. It has to
There's
be
a lot to
approved
break down here, guys.
40
I know they're getting
45
into
days
their,
before it happens,
some
so
of
there's
their
no ability to game market. So it's a
the
really good
political
system. It
aspect
worked here.
of the Fed, but there's a lot to break
And
down here.
I
We
think
will give that
all
to you.
said to each other today, yesterday,
And there's also
actually
some
yesterday
indicators too that
we
we're going to
recommitted to each
show
other
for
and
you
to
guys
this
that actually
institution
was
to hold ourselves to the highest
we had been
standards
looking at for quite some time. And again,
avoid
you
these
guys know my
problems.
position on this.
Do you have an update on the investigations that are pending?
We are going to
I don't.
continue to
So
see some pain
as you know,
here.
I
I still think our 14K Bitcoin is real.
referred
But we'll see.
matter concerning,
There are
President
some
Bostic
other
to the
indicators
Inspector
too. We'll
General.
show
Once
you
that
guys
happens,
that I think also
I
can
don't-
prep you for
I don't
how to
discuss
play
it
this
with the
market
Inspector
over the
General
next
with anybody.
few,
It's just
really
the
over the
Inspector
next few
General
months,
has-
which
he has the
we're
ability
going to
to do
have
investigation.
Jeff
We
Ross
don't
on
really
tomorrow.
have
We'll
that.
break this down
So
after,
that's what's
even though
going
he's going to gloat a little bit because we've been talking about this for some time.
Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve
That's a good
with
point.
100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over-tightened, particularly given that rates work with a lag.
Well,
Because this is not
so we
like
do
any
monitor
other
the near-term
scenario.
forward spread. You're right. And that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted. And also, you have to look at why things.
Just to be clear, guys, we are not giving up
the
on
rate curve
crypto in general.
is doing what it's doing. It
There
can be
is
doing
an
that because it
explanation
affects-
and a way
it
to
expects
play this
cuts or
market
because it expects inflation.
for this. In some cases,
In
many
this
people
case,
will look
if
at
you're in a
this as a great
situation where the
opportunity,
markets
and just
are
be
pricing
aware
in
that there are
significant
things
declines in
coming
inflation,
in
that's going to affect the
to
forward
the
curve.
market, and also
So,
the macro
yes, we monitor
aspect
it.
that I think
You're right.
will start to
and,
reveal themselves, especially, as I
that's what I'm
said,
saying.
November, not a good month.
Follow up.
December is going to be a big
You also
question.
said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that risk assessment has changed a little bit?
I don't think.
Well,
he's
what's
saying
happened
that.
is time has passed and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down,
Yeah, he's
you'll be
he's not
hearing
going
that from
back
me.
at all.
Again, if we over tighten, and we don't want to, we want to get this exactly right. But if we over tighten, then we have the ability with our tools, which are powerful, to as we
What
showed
tools?
at the beginning of
What
the
tools?
pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing
Pain
inflation
he's putting
behaving
on
the way
right
it
now.
can.
This
You're
is-
realizing
I
you
can't
didn't
imagine. What's
actually get it. You have
security?
to
I
go
haven't
back
looked at
in.
securities market yet,
By
but I'm sure the
then,
S&P is
the
just
risk really
freaking
is that
out.
has become entrenched in people's thinking, and the record is that the employment
quarter earnings
costs,
gonna
the
get
cost to the
cratered.
people that we don't want to hurt, they
Possibly
go up
the worst
with the passage of
holiday
time.
shopping
That's
season
that's
we
really
may be
how I
ahead
look at
of
it.
us
So,
right now. You
that
think
is a
this
big
isn't
change. What has
scaring
changed,
some
though, you're
people?
right,
Here
is
we are in
we're farther
November, right
along
before
now. And I
Thanksgiving,
think as
rolling
we're farther
into it.
along, we're now
and you
focused
get
on
this kind of
that.
update.
What's the place? What's the level we need to get to rates? And I don't know what we'll do when we get there. By the way, it doesn't. We'll have to see. There's been no decision or discussion around exactly what steps we would take at that point. But the first thing is to find your way there.
They don't even have a plan for when they slow down.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because that for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up the at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as non-new leases roll over and become and expire, right? There's still in the pipeline. There's still some significant rate increases coming. Mm-hmm. Okay, but at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that
Next
in
week
terms of
elections,
the
I
right
don't
way to
know,
think about
this,
inflation
well, I
really
do
is
know,
to look
yeah.
at
This was kind of already
the measure that we
predestined. They
do
already
look at,
knew
but-
they had
but
lost the
considering
election.
that we
This is
also
going to
know,
just continue the red wave, I think,
that
across a
at
lot
some
more
point you'll see rents coming down.
situations.
And just a quick follow, it looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a
Bonds?
problem or how that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher, and that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another, they go up, and that'll end when it ends, but there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking
Where did
about.
that
That's
come
really not a conversation to be had now. We have a ways to go.
I'm not even sure that was in.
And the last thing I'll say
question?
is that I would want people to
I mean, it's
understand
just like he
our commitment to
reiterates,
getting
we're
this
not going to
done,
pause. We're not going to
and
pause.
not making the mistake of not doing enough, or the mistake
Get
of
ready.
withdrawing.
We're not going to make the mistake.
Our strong policy and doing that too soon. So those I control those messages, and that's my job.
That's my job. Well.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
In theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. So I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, people are, the banks that deal with retail customers and many retailers will tell you that the consumers are still buying, and they're still they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
It's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still
All
see
right, so
pretty
guys,
significant
hopefully this
demand
is
and
something that you'll get a chance to kind of go back in and check the
overall,
Fed.
I'd say it's
All these
not
questions that
reflecting
you're
or
seeing
we're
right
seeing.
now that are
So we
coming
see
in
those things, and what those things
are really just a lot of reiterating what the Fed announced and what Powell was talking about. So you heard it. I don't think this is anybody on our channel right now that's watching this is thinking that this is not a bearish situation. This is definitely a hawkish move. The Fed is clearly not slowing down, and the question is going to be whether or not this can hold through the end of the year. Now, you guys have heard me say that November is a problem for what's happening right now, obviously from a political standpoint, but also from the Fed component and the pending data that's going to start support the CPI numbers in early December, which is another problem. December presents an issue because we'll start to get a little bit of notice as to how the quarterly earnings are going to show up across a lot of companies. And with that goes into my point, which is where we're going to probably see some very interesting things happen in Q1 because of the Q4 numbers. So you guys have heard me say that. This is one that, and just to kind of just showcase, I want to jump over to the CPI, our own data. Now, by the way, we're doing this daily now for you guys. So you can get to Bitcoin and all of these, and you can kind of see the numbers started sliding. Look at this amplification just fell out over the last few days in precursor, and then this morning's print obviously down from yesterday's print. So again, this is the direction of the market. I do anticipate we're going to continue to still, sentiment is slowing. This concern I have right now with Bitcoin is this right here, because we were starting to realign here with Bitcoin. And when I say realign, top line sentiment and what you see right here is called amplification. That's basically thinking forward-thinking sentiment, meaning people that are doing intent-based actions. I'm going to buy Bitcoin. I'm going to stack Bitcoin. Those kinds of things versus just general, I'm interested in Bitcoin, learning more about it. I hear so many good things. Those are kind of general top-line statements that we measure. And those are the things that really kind of fall in place when you look over here at the chart and where this is going right now. Obviously, just a kind of a reconstruction here. I think we're on Bitcoin, right? Yeah. So you can kind of see the scenario playing out for this. This is not something that's going to look good. I wanted to jump to a few points here, and then we'll cut loose. We'll do a full wrap of this. I'll do a full interview with Dr. Jeff tomorrow. We're going to break this down and really what this means long term, because I think there's some hidden messages in here that could give us some insights as to how to play this market if we start to see another downstroke. That's the big thing that could play into this. Now, one thing to be aware, and I wanted to kind of jump to a couple of tweets here. This is from Darius. We've had Darius on the show. Be clear, a Federal Reserve pivot is almost always bullish for risk assets, has been for a century. I've been saying all year, don't buy when there's blood in the streets. This is why you buy when there's cleanup. All right, so guys, right now we have blood in the streets. This is where we're at right now. The catalyst is what does have to happen within the market to be able to move this to a position where we might see a lightning, because I think 75 comes in on December. Right now, at the look of this, along with the kinds of things we're going to see from macro pressure outside of the Eurozone, because there's a lot there. I want to also showcase a tweet that I did the other day. I think it was last night or the night before. If you guys, I want you just to get a frame. And I'm not a long-time bear. I'm a bull, but we're living in a bear market, and you have to attach this to reality. I was reading this book right here. It's called Mega Threats. This will scare the crap out of you in the essence of what we'll see in the coming months and possibly years with extended inflation. So I can see why the Fed is pushing so hard. They're talking, or his anticipation, the author, Nouriel Roubini, he basically talked about the dollar to fall very sharp. Stagflation is now in play. We will see stagflation, which is where you basically are losing jobs and prices are still going up. That's basically the definition. Deep recession versus a general recession. This is a deep recession potential. And then inflation unbridled, meaning we are going to either hold at a very high percentage, close to double digits, for a longer period of time. And then this is the thing that's very interesting, is the globe could split kind of into a true East versus West. Now, it's kind of already East versus West, but I'm talking about everything. He talks about everything from internet, energy, healthcare, you name it. We are going to see a division and a deglobalization of what we're going to see, because it's going to be every country for themselves. This book right here will get you in a frame of what we may be facing in 2023. The question is how does this play out? But for those of you that have listened to some channels out there calling for pivot this year, I just don't see this is going to happen. You also, don't forget, you've got MicroStrategy coming with their third quarter earnings. It was, a shambles, which tells us that we've got a problem with a sailor, because how's he going to be able to gain access to more money at low rates to be able to essentially engage in more purchasing of Bitcoin, because that's what he's going to go after. So that concerns me there. And then you've got resistance mounting. This obviously we knew pre-FOMC. Doge has been on the fly here recently. We've got a lot in front of us, people. And I think the scenario that plays out right now is how does December look from a macro standpoint? Because I feel like we're going to see a CPI either flat or up. We're going to see job numbers start to really pour in. And I think we'll see real estate continue to dump. And with those kind of things, it's only gives syndication. This is going to be no reason for them to slow down in December is the point. And with that being the case, you're looking at potentially a market correction. Again, back to the statement I've said for the last 2 months, November is the month I'm worried about. In the sense, when I say worried, it's good if you're looking to buy crypto at the bottom, because I feel like the bottom may be in November. And if December gets a slight recovery, but up from what could be death zone type scenarios, Altcoins also lead the crypto market dump, basically ahead of the interest rate decision. Everybody kind of knew that as well. All of our indicators right now in sentiment have been pointing down since we've gone to data. So very cool. I think the scenario, when you guys want to jump in over there, you can grab CPI, our CPI, meaning Crypto Power Index, on a daily basis now. We're dropping that in there. So let's take a look at Ethereum right here. Again, Ethereum starting to separate right there. There's several. Binance, what are they doing? Binance tipping down just a little bit. Let's jump to the poll real quick, and then we'll take a few questions. Okay, or maybe not. Oh, by the way, thanks for the birthday mentions, guys. Yes, it is the birthday, so. Anyway, let's jump to the poll real quick. 24 hours after the Fed meeting, crypto market will have crashed, rallied, remain the same. I think we may be down a little bit here, so I'm going to go on the crashed at 33%. Interesting number. I hate that number. I love that number. I hate that number. But anyway, we're going to wrap up here today. If you like these live streams like this, where we do the restream and do a little bit of commentary afterwards, smash the like button. It lets us know you want us to continue. We are going to bring on a lot more macro analysts this week, next, and more. Along with some Bitcoin people that I think are going to be interesting to listen to, because there's some interesting plays starting to come into. We've got a video coming up also on Polygon and what JP Morgan just did in DeFi. Don't miss that video. This is big news, and it's this framework of what's getting ready to happen. This is an exciting time. I know this is bad news, but get ready. I think we're in for some interesting stuff ahead right now. All right, we're going to wrap up out of here, guys. If you're not part of the Diamond Circle, get in right now. It's free and it's simple to join. All you have to do is click the link below, and you're going to get in on updates, additional content, all kinds of stuff from the Crypto Pit, as well as, guess what? We do our own sentiment data inside the Diamond Circle now, where we'll drop a little bit in there for you guys, absolutely free. So sometimes we show it on the show, sometimes, but there's now almost, we're approaching 40 tokens plus. We're going to hit 50 by year end. So we've got a lot happening. Everything's clicking along right there. Make sure and join in over there. If you want to catch me on Twitter, it's @Paul Barron. We'll catch you next time right here on TechPath.